Hello everyone, this is Zak Gardezy. I'm the host of Money Minutes. I'm also the founder of Wealthstone Private Wealth Management and a certified financial planner. So here on Money Minutes, I share with you some of the latest market headlines and my outlook for what's ahead. So for this week's episode, we're going to cover the Federal Reserve's decision to cut interest rates by 50 basis points. So this means that they've ended their restrictive monetary policy campaign, and the Fed has some pretty different views of what's happening in the economy, and they took action. So we'll talk about that. I'll answer some of the top questions that I'm getting, such as what does this mean for the economy and the overall stock market? I'll also answer questions about mortgage rates and what does it mean for that part of the market, and on high yield savings accounts and money market funds, what should investors be aware of? So let's get right into it. So to kick things off, if you'll notice, there's a different background behind me. I'm in New York City. I'm here attending the Blackstone University Due Diligence Conference, so thank you to Blackstone for hosting me. It's been a great opportunity to hear from some of Blackstone's sharpest minds, their portfolio managers and investment strategists, hearing about their insights and perspectives on the overall economy. So for Wealthstone clients, you're familiar with Blackstone because we utilize their investment strategies. And for others, Blackstone is a leading private equity manager, one of the best in the world. And really their insights are extremely valuable. So, they own many companies around the United States. They're one of the largest employers technically, and they also own many properties around the country too. So their insights in the real estate market is extremely valuable. And so again, thank you to Blackstone and those for hosting and for putting on a great conference. I appreciate the time and look forward to sharing these valuable insights with Wealthstone clients. So let's get into today's topic. The Federal Reserve cut interest rates by 50 basis points, or 0.5%. What does this mean for the overall economy and the stock market? So the Federal Reserve decided to take this action really because they have two mandates. One of them is price stability, and the other is achieving maximum employment. Now, price stability really has to do with inflation. So the Fed has been trying to fight inflation since it was out of control in 2022 and still is higher than their 2% target. However, on the other hand, the Fed also has a responsibility to maintain maximum employment. So we've seen over the last few months a weakening in the labor market, enough so that it concerned the Federal Reserve to make a shift in their monetary policy. So the Federal Reserve cut interest rates, and in doing so, they're trying to stimulate the economy. When the Fed cuts interest rates, this typically lowers borrowing costs for companies, and eventually it leads to the lowering of interest rates for things like mortgages and credit cards and auto loans as well. We'll talk about later how the Fed doesn't directly control those things, but they have indirect influence, and we'll talk about how that all works. But for the overall stock market, this is typically a catalyst for when the Federal Reserve lowers interest rates. If we look over the historical numbers, when the Fed starts to cut interest rates, typically over the next 12 months, we see the stock market react positively. Again, remember, if we're lowering borrowing costs for companies, they're able to, of course, pay less interest, which helps the bottom line, but then they're also able to invest that money into other parts of their business, acquiring companies, potentially investing more in R&D, and these are all things that are seen as stimulating to the economy and typically a boost. Now, one interest rate cut's not going to do it. Just like how when the Fed in 2022 started raising interest rates, it took time for that to affect the economy. It's going to take time for these interest rate cuts to bleed their way into the economy as well, and it's going to take more than one. So now the attention has shifted to how many more cuts are we going to get. A lot of speculation there. But I think if we look at the European Central Bank as an example, they cut interest rates, and they're playing it really month by month and analyzing the data. If they see an uptick in inflation, which is possible here too, they're not going to cut interest rates. It's a significant risk here because, as Chairman Powell noted, they're not committing to cutting rates more. If the data reverses and we start to get an uptick in inflation, the Fed's probably going to pause or even raise interest rates again. So I still think there's a lot of volatility involved when it comes to Fed actions, but it's welcoming news that the Fed has decided to cut interest rates, and typically good for the overall economy. Now, shifting gears to mortgage rates. Mortgage rates, again, as I mentioned, are not directly impacted by the Federal Reserve's actions, unless we're talking about home equity lines of credit, which are variable rate and they're tied to prime. That will get lowered. But if we're talking just primarily about mortgages, and we're talking about, for example, fixed rate mortgages, those are going to be fixed rate. So those rates are not changing because if you already have that mortgage, you're locked in for a certain number of years, 30, 20, 15, whatever that is. But for anyone who's looking at refinancing or maybe buying another home and looking at the mortgage rates today, you're probably looking at them and going, oh, okay, these rates are a little bit better than where they were just a few months ago. And that's the case. So when the Federal Reserve starts to lower interest rates, typically what happens is the 10-year Treasury precedes that. Now the 10-year Treasury is a bit closer of a benchmark for mortgage rates. The 10-year Treasury, as I mentioned, it tries to, in a way, because it's driven by the market and investor sentiment, the 10-year Treasury could try and predict or get ahead of what the Fed's going to do. So we saw in October of last year, it was at 5%. Now it's in the 3.7% range. And so that was without the Fed actually taking any action. So as the Fed continues this campaign, I do expect the 10-year Treasury to keep going lower, ultimately lowering mortgage rates. Now that kind of just a good transition to what's going to happen to deposit yields, right? High yield savings accounts and money market funds. So banks, of course, take in deposit assets and then they lend that money out using vehicles like mortgages. So if mortgage rates start to go down, let's say the bank is paying 5% interest. They were once charging 7% for mortgages. Now they're charging 6%, or maybe they're charging 5%, right? At a certain point, the banks can no longer afford to pay those high deposit yields, and they have to start lowering those interest rates that they're paying depositors. So as someone who has assets in a savings account somewhere, you need to start looking at your deposit yields. Your bank may or may not let you know that they've dropped their deposit yield, but you pay attention to it and start to look at other options in the market. That's something that I've been doing with Wealthstone clients all year, as we've predicted the Federal Reserve would eventually start to lower interest rates. So there are other areas of the market that you can invest capital into, and it's something that I recommend investors start looking at as their deposit yields eventually start coming down. Now, money market funds are a little bit different. We'll focus on government money market funds. Government money market funds typically hold treasury bills. Now, treasury bills mature fast. And so every time those treasuries mature inside the fund, right, because this government money market fund is holding many treasuries inside of it, the fund manager needs to replace those matured treasuries with brand new treasuries, and those yields are dropping week by week, basically. And so what we're seeing now is government money market funds paying less interest. I think that trend will continue, and it's going to be something where I think investors start looking at investing in other places just because they need to replace that lost income with other investments. Maybe it's private real estate, maybe it's credit, maybe it's investing in the stock market. That's something a financial planner can help you figure out to determine how much in which area and what makes sense for you. So hopefully this answers the top questions that I've received. If you have any other questions or would like to go into more detail, please don't hesitate to reach out. Thank you again for tuning into this week's episode. Hope you all have a great week.